Alright, hello everyone, Lance Ippolito here, your trading guru, obviously. A couple things to start off. I am on Twitch live at first hour of the day, the equity market open, and I've been going on sometimes in the afternoon, so either go to Twitch or become a member and chat that way. So let's get into what I think we can have. So after hours, we have the S&P E-mini down. What are we down? 11 and a quarter. We do have crude oil up. That is something bullish for equity markets. And we have the yen up, and therefore we have gold. Yeah, gold up a little bit too. So let's chat what's happening here. First, and I have to bring it up just to get out the way, and I'll get out of my rants. I still think a lot of this is the crypto crash, people having to pull money out of that, and therefore taking money out of stocks to make up for their crypto losses. Basically, if you have an asset class blow up, I don't care what asset class it is, if it involves money, it's going to hurt every asset class across the board, in this case, U.S. equities. So let's chat about U.S. equities and then chat about the European financial crisis or banking crisis that could really be the next thing that could really crash the markets, which I hate using that word, but it's true. Obviously, we've seen the '08 financial crash, but let's talk about here. SPY, we have retail buying. So when your mom, your pop, your friends and family and your buddies at the bar start talking about equities, usually that's a time at the top, and we had the president, not to get into politics, touting them every day. Hey, they continue to go up, didn't think much of it, but, in January, so this is January, markets went straight up. Even a blind squirrel was making money. You could throw darts at the market was going up. Then we had the vol crush, so what is called the VIX vol funds crash. What was happening was volatility funds were selling one standard, two standard deviation SPY or SPX puts every week, and the strategy worked for 5 years or so. And what they do is when the market goes down, let's say they sell the 280 puts, they roll to the 275s, the market kept going down, they roll to the 270s, and eventually they have no more capital to sell their puts, and they get blown out because they have to buy back their puts at a higher price. So right now we've seen a low volume sell-off, right, up until really today, which was even low volume, blame the snowstorm. I need to stop drawing there. And we're continuing now. We've had some presidential news, stuff like that. We can't really plan for that. The tariff news now, all affecting the markets here, especially the S&P futures overnight. So we took out the retail traders, everyone who came back in the market in 2018. Now they're down for the year. When people who normally don't get involved are losing money, they panic, and what do? They sell. So they see that today when they look, they check their stocks or their portfolio, their 401ks, they see that, hey, they're down, they panic, they sell. That can contribute to some of the late day selling, and we could see some selling tomorrow morning. The scary part for me is if we limit down Friday or Monday, we got Black Monday where we limit down pre-market. I think it'll create a great buying opportunity. Limit down will be about 5% of the in the futures, and that could really cause a lot of pain. And eventually, I think we could retest 258 or so in the SPY. But if you think of the market in general, look at the weekly. If we really want to talk about market crashes from '08, to '08, beginning of '09, we're up a lot. And when we look at the SPX, even something sounds absolutely bonkers, 2,500, 2,400 would not be that much of a crash. It would just be a slight correction. If we absolutely crash, I think we trade somewhere around 2,200 to 2,100. That would just knock everyone out, because the whole recovery and the equity market boom from Trump, we give back everything, and I would not be shocked if that happens, actually. But again, we're giving back a lot of gains. Retail, we've never seen volatility like that, or at least short term. A VIX 75, we're used to VIX, 13, 14, 15. Even a VIX 20 is just absolutely crazy right now. Where are the VIX futures? Up 3%. I mean, if you look at the VIX futures, they're really not even up a lot. So, compared to February. So just remember that. So what I'm looking at more importantly is the European banks. So first, if we look, and this is all weekly charts, if we look at Bank of America, or if we look at the XLF in general, U.S. financials have done quite well. Obviously, a huge recovery since the crash. JP Morgan, one of the top names in the group, and they're just sitting up here toppy. I'm not going to say they're going to crash. Obviously, JP Morgan here, $10 off the highs is nothing. But what is starting to get scary is this. When I pull up names in the European banks like Deutsche Bank, which Deutsche Bank is $5, $6 off the highs, and this is not a healthy looking chart. Remember Deutsche Bank during the financial crisis, and that reminds me of banks like HSBC, another European bank, which again we break support today. It's got a lot of room to the downside. This could really get scary. And we have, names like AIG, obviously very bearish looking charts here, looking like complete messes. Even Credit Suisse here on a weekly. Credit Suisse was really outperforming up until a few months ago. Here's Credit Suisse breaking support. So what scares me is specifically Deutsche Bank and the derivatives desk. It's the largest out of the group. And I know they've been cutting their workforce over the past couple years. If we start having a Deutsche Bank start with warning signs, so Deutsche Bank just starts really crashing and we start seeing far out of the money puts. I mean, I did see some far out of the money puts in Deutsche Bank, I believe today, if I recall. Let me just check here. I mean, traders were buying. You can see here, April or October 12 puts, over 10% out the money. July 14 puts, June 12 puts. They're loading up on some puts here in Deutsche Bank. If Deutsche Bank goes under, and I think with the European banks, here in the U.S. how we just bailed out everything, I think over there they'll be a lot more conservative and not want to get involved to help these banks out, and therefore that the European financial crisis could roll over to our banks. We could look at XLF as a good gauge, the financial ETF, and if we have banks roll, again XLF, look at this thing on the weekly, straight up, we could be in a lot of pain. Maybe these European banks we haven't actually done too much research on. We say, oh, Bank of America, JP Morgan, strong, Jamie Dimon. Who will pick up? Will it be something like a Lehman Brothers case? Will it be something where JP Morgan steps in and buys a bank? I don't know how they could finance, or I don't know how that will be done now. We talk about breaking up the banks. The banks, if more go under, we might just have a few big banks ruling the world, and we can already say that now, but especially after the European banks. I just think a lot of these banks have too much on their plate, especially names like Citigroup, to where, obviously a huge rally here, but when we're looking at, international countries, Citigroup with their Latin American exposure, could get a little ugly because commodity prices, hurting these countries and really affecting Citigroup. I mean, Citigroup now breaking support too for a U.S. bank, down 4% today. These just aren't normal. And we do have bank earnings, it looks like the second week of April. So I'll wrap it up there. Just wanted to share kind of a bear thought here. But some things are looking scary. It's the first time I've seen financials really act weird, so to speak.